Imagine, for just a second, that you are holding your smartphone in one hand.
Okay, I'm picturing it.
You open your banking app, you look at the screen, and you see a number that basically represents your life savings.
Right. Just glowing digits.
Exactly. Now imagine holding a solid 1 ounce gold coin in your other hand. I mean, it's heavy, right? It's cold.
Oh, yeah. It's incredibly tangible.
Yeah, and for decades, the entire global economy has essentially demanded that you trust that glowing number on the screen.
Absolutely.
But on this Monday, May 4th, 2026, the financial data is showing a massive, almost desperate pivot back to that cold metal. We are unpacking the modern resurgence of a very ancient obsession today, which is precious metals.
It really is a profound psychological shift. I mean, we're watching millions of people and institutional powers, too, move from trusting these highly complex digital systems to seeking out the oldest, most uncompromising form of wealth on the planet.
Right, and that tension between the digital illusion and the physical reality is exactly what we are exploring today.
Which is a lot to cover.
It is. But to help us navigate this, we have a really fantastic stack of sources. We're diving into a comprehensive analytical article titled Why Investors Are Shifting to Precious Metals by veteran financial market researcher Doug Young.
He's great.
Yeah, and we are pairing that with real-time market bulletins and news headlines from the Gold IRA company's bulletin. So, okay, let's unpack this.
Let's do it.
We are cutting straight through the noise to explain the actual mechanics of why regular people and massive global central banks are suddenly hoarding gold and silver.
And we'll look at how these assets actually function or, fail to function in a modern portfolio.
Exactly. And we'll expose the structural traps waiting for overly eager buyers.
Yeah, my focus today is really on synthesizing these complex market signals so you, the listener, can understand the underlying forces driving these headlines. Because there is a relentless amount of hype right now, particularly online.
Oh, the online hype is out of control.
It is. And we need to look past the panic to examine the actual plumbing of the economy.
Right. Well, let's start with the immediate catalyst. If you are looking at your portfolio right now, you aren't just idly wondering about economic theory.
No, not at all.
You are actively trying to figure out how to stop the bleeding. The raw cost of living is just outrunning incomes. Housing, transportation, basic logistics.
The basics.
They are consistently commanding more of our capital. The purchasing power of fiat currency is visibly eroding.
It creates a really volatile environment for the investor. I mean, the dilemma you face right now with cash is a brutal balancing act.
How so?
Well, if you hold cash, you maintain perfect liquidity, right? But you guarantee a loss of purchasing power to inflation.
You're just losing money slowly.
Exactly. But if you lock that capital up in assets to chase yields, you take on market risk and sacrifice your liquidity.
Man. I was looking at Doug Young's analysis of the macroeconomic backdrop, specifically regarding government debt. And I think we need a better way to visualize what is actually happening.
Okay, let's hear it.
It's basically like running a household entirely on credit cards while the price of groceries doubles every few years. Expanding the money supply while producing the same amount of economic goods is essentially like watering down the soup at a restaurant to serve more customers.
That's a great way to put it.
Right. Like, sure, the volume of soup goes up, but the nutritional value of every single spoonful just plummets.
It does.
But here's my question for you. How does that high-level public debt directly cause an individual to, like, log on and buy a silver bar? Is it a direct one-to-one reaction?
If we connect this to the bigger picture, it's less of a direct reaction and more of a systemic flight to assets that exist totally outside the banking system.
Outside the system entirely.
Right. Consider the mechanics of modern finance. When central banks expand their balance sheets to manage unprecedented public debt, they don't just print physical money.
They don't just run printing presses anymore.
No, they inject liquidity into a web of highly leveraged, deeply opaque derivatives and securities.
Stuff the average person can't even see.
Exactly. The average investor looks at this system and realizes they cannot possibly audit it. They have no idea where the counterparty risks actually lie.
Wow.
So when the cash in your wallet is losing value, and the banks holding your digital money rely on a derivative web you can't verify, you experience a loss of systemic trust. You seek out a hard asset.
Something that does not rely on another party's promise to pay.
Precisely.
And we are seeing that exact loss of trust play out globally in today's bulletins. Like, from the May 4th headlines, there is a major indicator out of India.
Oh, the jewelry pivot.
Yes. Investors are actively pivoting from traditional gold jewelry straight into investment-grade gold bullion. That is a massive cultural shift.
It really is.
They aren't buying it for adornment, they're buying it as a hard financial shield.
Yeah, when you see a historically jewelry-driven market pivot entirely to investment-grade bullion, it signals that the anxiety about localized purchasing power has basically overridden cultural traditions.
The primary utility of the metal shifted from social status to financial survival. And we don't even have to look abroad to see the urgency. Over the last few days, there has been a flurry of domestic news regarding retirement infrastructure.
Right. The new policies.
Yeah, we're seeing headlines about the unveiling of TrumpIRA.gov alongside recent executive orders creating new retirement accounts aimed directly at workers who fall outside the traditional 401k umbrella.
Which is a growing demographic.
Huge demographic. And look, to be clear, regardless of where you fall on the political spectrum, we are just looking at the source material objectively here.
Right, impartially.
Yes.
Yeah.
And these developments point to a recognized systemic failure of the old models. The traditional avenues for building wealth are leaving people exposed, and it's forcing them to take an aggressively defensive posture with their retirement.
And that defensive posture is precisely what drives individuals to look backward. When modern, highly engineered financial products feel fragile, investors inherently look for the asset that has survived previous centuries of systemic collapse.
Okay, but wait. Here's where it gets really interesting. If central banks are buying it up, it's tempting to just follow suit. But if we look closely at how governments have treated gold historically, it's not always the safe harbor people claim it is.
No, it is not.
In Doug Young's research, he explicitly points out that governments have literally banned or heavily restricted private gold ownership during past periods of currency stress.
They absolutely have.
So if gold is the ultimate historical safety net, why is it treated like a rebellious act? Why do governments view it as such a threat when the economy gets rocky? What does that mean for investors today?
Well, it comes down to the mechanics of fiat currency. A fiat currency works because the population has no other choice but to use it.
Right.
And that gives the central authority leverage to inflate or deflate it as needed to manage sovereign debt. But if citizens can easily convert their wealth into private gold hoards, they effectively opt out of the national currency experiment.
Oh, wow. So it undermines them.
Exactly.
Yeah.
A massive private flight to gold actively undermines the central bank's ability to manage a crisis because it drains confidence and capital from the banking system. So history shows us that when currency stress peaks, governments absolutely will change the rules of the game to force capital back into their systems.
Which means looking at history as a comforting guarantee is just a mistake. The policy responses in the 1930s and 1970s won't be the exact policy responses in 2026.
No, you cannot assume a linear repetition of history. Every period has its own policy choices. However, and this is key, what makes the current moment unique, and what Doug Young highlights, is the behavior of the central banks themselves.
Right.
While they might restrict private capital flight, the central banks of major global economies are currently accumulating massive amounts of gold for their own foreign exchange reserves.
I mean, it feels incredibly hypocritical. They want us to trust the fiat system while they are quietly backing up the truck for physical bullion.
It does feel that way.
Yeah.
They are hedging against geopolitical uncertainty and the potential fracturing of the global reserve currency system. But the listener needs to understand a critical divergence here.
Which is?
A central bank's motives are entirely different from your motives. A sovereign nation buys a 400-ounce gold bar to balance international trade settlements or project geopolitical power. They have infinite time horizons.
They aren't worried about paying rent next month.
Exactly. They don't worry about liquidity squeezes. An individual trying to protect a retirement account has a finite timeline and very different liquidity needs. You cannot simply mimic a sovereign nation's strategy and expect it to work for a household.
That is a phenomenal point. A central bank isn't worried about the transaction fees on a sovereign wealth transfer.
Not at all.
But an individual trying to buy gold faces an entirely different, structurally riskier market. So let's dig into those mechanics. Doug Young's article breaks down the methods of exposure, and they are far more complicated than just hitting a buy button on an app.
Oh, absolutely. The method of exposure drastically alters the risk profile of the investment.
Let's start with exchange-traded products, or ETPs. The appeal is obvious, right? You can buy them right in your brokerage account alongside your standard index funds.
Super convenient.
But the article explicitly warns about counterparty risk. How does an ETP actually expose you to the exact systemic risks you are trying to avoid by buying gold in the first place?
This is a crucial mechanical flaw that many investors just overlook.
Hmm.
When you buy an ETP, you do not actually own gold. You own a paper or digital claim on a trust or financial institution that supposedly holds the physical metal,
So it's an IOU.
basically.
Yeah.
And if that institution or the custodian they use faces a severe liquidity crisis or bankruptcy, your safe haven asset is suddenly tied up in bankruptcy court.
Wait, really? You can't just get your gold?
No, you cannot simply go to their vault and demand your coins.
Yeah.
You are tethered to the very banking system you are trying to hedge against.
So you're just trading one illusion for another. Then there are futures contracts, which the sources mention, and these are heavily leveraged.
Right. Futures are derivatives where you agree to buy or sell metal at a specific price on a future date. The leverage means you only have to put up a small percentage of the total contract value.
Which sounds great for gains.
It does, but while that magnifies gains, it equally magnifies losses. If the price of silver drops sharply overnight, you can face a margin call.
Ouch!
Yeah, meaning you are forced to deposit more cash immediately or have your position liquidated at a massive loss. It is an arena for sophisticated hedging, not for parking a retirement nest egg.
Which brings us back to the heavy cold metal, physical bullion, coins and bars. But even here, there is a fundamental structural drawback that investors just seem to ignore when the hype gets loud.
The lack of yield.
Exactly. Buying physical gold is essentially like buying a vacant lot of land. Sure, that land might go up in value over the next decade, but it doesn't pay you rent while you wait. Precious metals have zero yield. There is no income stream. Unlike a dividend-paying stock or an interest-bearing treasury bond, you receive absolutely no cash flow.
What's fascinating here is that the lack of yield completely changes how the asset behaves in a portfolio.
How so?
Well, because there is no underlying cash flow to anchor a fundamental valuation, the price is driven almost entirely by market sentiment, interest rate expectations, and geopolitical headlines.
Which means wild swings.
Right. It creates extreme price volatility.
And we can see that extreme volatility colliding in the real-time bulletins from our sources. We have two headlines hitting just days apart that tell wildly different stories.
I know exactly which ones you're talking about.
Yeah. On May 4th, we see a report out of India about a sovereign gold bond maturing with an astonishing 386% return for its holders. But contrast that with a headline from Bullion Vault from just a few days prior. Non-investment gold demand collapses at record prices.
Yeah, those two headlines perfectly illustrate the brutal reality of timing risk. A 386% return over the lifespan of a bond is spectacular, but it is heavily dependent on a specific entry point and a long lockup period.
You have to time it perfectly.
You do. When gold reaches record nominal highs, consumer and industrial demand often plummets because it simply becomes too expensive to utilize. Rapid parabolic price spikes in precious metals are notoriously fragile.
And they usually crash afterward, right?
They are frequently followed by devastating multi-year drawdowns.
Man, so if you buy near the peak of the hype cycle, you might be waiting a decade just to break even. And remember, during that decade, you weren't collecting any dividends to soften the blow. Inflation is just eating away at your capital while your vacant lot sits there.
Precisely. And beyond the market risks, Doug Young highlights the acute structural risks of the retail market. He calls it provider risk.
Oh, this part was wild.
Yeah, the precious metals industry operates with significantly less regulatory oversight than traditional securities.
He mentions counterfeit products, which is terrifying, but the more insidious risk seems to be liquidity obscuring. These dealers make it incredibly easy to buy, but they hide the massive spread you'll have to pay when you try to sell it back to them.
That is the hidden tax of physical metals. You pay a premium over the spot price to acquire the metal, paying for manufacturing and dealer profit.
Right.
But when you need to liquidate and sell that metal back to a dealer, they will often only offer you the spot price, or even below it. You are instantly losing capital on the spread.
That's brutal.
It is. If you do not meticulously read the fine print regarding a provider's buyback program and liquidity terms, your so-called hard asset might trap your wealth when you need it most.
So with the reality of provider fraud, extreme volatility, massive spreads, and zero yield, we have to ask why there is such a deafening online frenzy telling people they need to liquidate their savings and buy silver right this second. The psychology driving this market is intense.
It really is. The digital amplification of fear is an incredibly effective marketing tool.
Oh, absolutely.
Social media algorithms reward urgency and panic. Influencers and bloggers frame precious metals not as a boring portfolio diversifier, but as this revolutionary act to, beat the system before an imminent collapse.
They exploit very real anxieties. Like one specific concept from the research that influencers seem to weaponize constantly is the idea of bank bail-ins.
Yes, that comes up a lot.
It sounds terrifying on TikTok, but what is the actual mechanism of a bail-in and why does it send people rushing for gold?
So a bail-in is a regulatory mechanism implemented largely after the 2008 financial crisis. During 2008, taxpayers footed the bill to bail out failing institutions.
And people were furious.
The public backlash was immense. So regulators changed the framework. The new rules state that if an institution fails, the losses must be absorbed internally before any public funds are used. This means shareholders are wiped out first, followed by unsecured creditors.
And in some jurisdictions, large depositors are classified as unsecured creditors.
Correct. If your deposits exceed the government-insured threshold, like the FDIC limit in the U.S., that excess capital could theoretically be converted into bank equity to recapitalize the failing institution.
Meaning you take the loss.
You take the loss. The mechanism is designed to stabilize the financial system without taxpayer money. But psychologically, it introduces the terrifying concept that the money in your bank account is not actually yours. It is a liability of the bank.
Okay, wait, I have to challenge this narrative, though.
Go for it.
If the global financial grid actually goes down to the point where major commercial banks are executing depositor bail-ins across the board, an ETP or a digital gold receipt is just as useless as fiat currency. Aren't people panicking over bail-ins just trading one digital illusion for another?
Oh, 100%.
Like if the grid goes down, how are you going to spend a 1-ounce gold coin at the grocery store?
You hit on the fundamental contradiction of the doom-scrolling narrative. If society reaches a point of total systemic failure, a gold bar is largely useless for daily transacting. You can't shave off a piece of gold to buy bread. This is why Doug Young's analysis is so crucial. He cuts through the apocalyptic marketing and pulls the listener back to financial fundamentals.
So what does this all mean for the listener? How do you separate a genuine portfolio diversification strategy from doom-scrolling panic? Because Young has, what, over 2 decades in financial markets, 16 years as a financial director, and 15 years evaluating gold IRAs specifically.
He's incredibly experienced.
Right. He is not a YouTuber trying to sell you a survival kit.
No. His core thesis is that true financial resilience is built on discipline, not a magic asset. Before you allocate a single dollar to gold or silver, your foundational buffers must be locked in.
But the foundational buffers are boring. Nobody wants to talk about paying down credit cards when they could be buying silver bars to fight the Fed.
They are boring, but they dictate your survival. If you purchase physical gold without holding sufficient liquid cash buffers, you are walking into a trap.
Give us an example.
Let's say you buy gold at the top of a hype cycle. A year later, you face an unexpected medical bill or a job loss. Because you lack a cash buffer, you are forced to liquidate your gold to pay the bill.
Ah, I see where this is going.
Right. If the gold market happens to be in one of its extended drawdowns, you are forced to sell at a massive loss, paying the dealer's spread on top of it. Your attempt to protect your wealth just destroyed it because you failed to manage your liquidity risk.
Oh, man. So holding a high-yield savings account, even if inflation is biting into it slightly, is basically the cost of insurance you pay so you don't have to fire sale your physical assets during an emergency.
Exactly. Gold and silver can serve as long-term, non-correlated assets within a broadly diversified strategy. But they are a terrible substitute for liquid emergency reserves or maximized tax-advantaged retirement vehicles.
Okay, let's bring all of this together. We have mapped out a really complex landscape today. What the sources reveal is that gold and silver are undeniably fascinating, historically rich assets.
They really are.
They offer a heavy, tangible alternative to an opaque, derivative-laden financial system that increasingly feels like a house of cards. But they are not a magical shield.
Far from it.
They provide zero yield, they suffer from extreme price volatility driven by sentiment, and acquiring them safely requires navigating a retail market fraught with high fees, liquidity traps, and predatory marketing. It really requires a cool, educated approach rather than a speculative frenzy.
It requires an analytical, cold approach. You have to weigh the opportunity costs of zero yield, understand your specific timeline, and rigorously vet the institutions you choose to transact with. It is an arena for clear-headed strategy, not emotional reactions to social media algorithms.
And if you are ready to apply that clear-headed strategy and you want to explore this topic further, specifically if you want to see objective side-by-side analyses of the different companies operating in this space, you should visit the Gold IRA Company's bulletin.
Highly recommend it.
Their research hub is at goldarcompaniescompared.com. It is a fantastic wealth of related information for cutting through the marketing and understanding the fee structures and liquidity terms of the major players. We have placed a link directly to that research right below in the deep dive notes so you can easily verify the data for yourself.
Before we close, I want to leave you with a concept that reframes everything we've discussed today.
Let's hear it.
We've spent centuries moving away from physical gold to build a digital, interconnected global economy based entirely on institutional trust.
Right?
But simultaneously, those exact same central banks hoarding gold are accelerating the development of central bank digital currencies, sub-EDCs. They are building programmable digital money that can track and potentially restrict every single cent you spend in real time.
Oh, wow.
So if millions of people, and even the world's most powerful financial institutions, are suddenly feeling the urge to hold a heavy piece of metal in a vault again, while simultaneously building a completely surveilled digital grid for the public, what does that tell us about the future of trust itself?
Man, that casts an entirely different shadow over the idea of going digital, doesn't it? The ultimate disparity between what the institutions build for us and what they hold for themselves. Thank you for joining us on this deep dive. Keep questioning the consensus, keep reading the fine print, and we will catch you next time.